Over the past few months, we have seen three major bank failures that were bigger than the 25 that failed in 2008. And now we're seeing another one go down. In the last 12 months, we have seen the collapse of Silicon Valley, First Republic, Signature, and the Citizens Bank. This one is in the United Kingdom. It's the Metro that's collapsing. Set up in 2010 as a challenger to bigger, more traditional lenders, it has since been struggling to raise fresh capital to shore up its balance sheets. Fitch has downgraded the corporation in its ratings. In fact, it has a negative rating now, and its stocks have dropped by 30%. This is going to be the first one to go down before the chain reaction starts, and a lot more will go down all around the world. These challenges for the Metro Bank are not new. The woes go way back to 2019 when it faced an accounting scandal where it was revealed that it had miscalculated the risk weighting on some of the mortgages it had written, which meant it hadn't put aside enough regulatory capital to back those loans. It was fined £10 million as a result. It has since been struggling to get on a path to sustained profitability. The reports say that the corporation was looking to raise money from investors, lenders, and possibly considering selling some of its mortgages before it needs to refinance some of its debts. This is a clear indication that it is facing financial challenges. Fitch has recently downgraded it and put it on Rankings Watch Negative. They noted that Metro Bank's earnings prospects would come under pressure in the short term due to rising funding costs, resulting from higher competition for deposits and given likely more expensive access to wholesale funding. In addition, capitalization is tight. It was urgently seeking to raise funds to shore up its finances, which led to the stock crash. It was exploring options to raise as much as £600 million in debt and equity to bolster its finances. It confirmed that it met its minimum capital requirements and had not made a decision on fundraising plans. Metro Bank recently brought in Morgan Stanley as an advisor. Its customer deposits are backed by a government guarantee up to £85,000. Fitch says it will remain in loss for at least one more year based on wider net interest margins. The lender expects the majority of restructuring costs to have been expensed or capitalized, with a return to a more normalized cost base from 2022. Loan impairment charges are budgeted to remain low over the next 2 years, although uncertainties remain in the current macroeconomic environment. It also says that risks surrounding its ability to refinance maturing debt that qualifies for minimum requirement for own funds and eligible liabilities have increased. This will reduce the protection available to its senior creditors from the group's buffers. Due to all these reasons, it has dropped in rankings. But how does this affect us? Well, when a prominent bank like Metro faces financial turmoil, it leads to a loss of confidence in the entire sector. Investors and depositors start questioning the stability of other institutions, potentially triggering a contagion effect. This results in a domino effect of failures as customers rush to withdraw their funds from other depositories as well. Banks are deeply interconnected on a global scale, with complex monetary relationships and interbank lending. Metro's troubles are linked to others through loans, investments, and derivatives, Therefore, the crisis will easily spread across borders, affecting corporations in the United States and elsewhere. It will also have a severe economic impact. It will disrupt lending, leading to a credit crunch that affects businesses and consumers. This, in turn, will hamper economic growth, leading to a recession. Governments will need to intervene to prevent systemic collapse, which often involves massive bailouts and liquidity injections. Taxpayers will have to bear the brunt of such interventions, leading to public outcry. The previous crises were also an embodiment of the broader issues facing the economic sector, including the overexposure to risky assets, poor risk management practices, and the interconnectedness of financial institutions. A London-based lender is reportedly trying to sell 1/3 of its mortgage portfolio to raise cash and is seeking $730 million from new investors. It is hoping to complete the sale of the mortgages by the end of the year. The sale of the portfolio is part of an attempt to shore up its finances and raise capital from investors alongside asset sales. It has also approached larger rivals about selling a portfolio of residential mortgages. It has been forced to sell assets in the past, announcing a deal in December 2020 to sell a portfolio of owner-occupied residential mortgages. Its major existing shareholders include billionaire Vernon Hill and fund manager Fidelity. It has been struggling to get approval from regulators to adopt a new way of valuing mortgages, which has been a problem. It has been facing criticism for its accounting practices and the way it had disclosed information to investors. It is a sign of its financial instability, and it has been facing a range of challenges, including regulatory hurdles, criticism of its accounting practices. Its reputation has also been damaged by the resignation of its founder and criticism of its corporate governance. We're going to see bank runs and customer panic. Both these are highly concerning events, having significant implications and consequences for both individuals and the broader economy. When people lose confidence in the stability of their banks, they rush to withdraw their funds, triggering a vicious cycle of economic instability. The primary implication of a bank run is a loss of trust in the banking system. When one institution experiences a run, it erodes confidence in the entire sector, causing people to question the safety of their deposits. This loss of trust has long-lasting effects, making it difficult for them to attract and retain customers in the future. It also leads to economic instability. As more and more people withdraw their money from banks, it leads to a liquidity crisis. Corporations struggle to meet the demands of their clients, forcing them to sell off assets at fire sale prices. This often has a domino effect, affecting other financial institutions and causing a broader economic downturn. Like any other corporation, if Metro faces a bank run, it will lead to a credit crunch, as they will become hesitant to lend money. They will have to maintain sufficient reserves to meet customer withdrawal demands, which will leave them with less capital for lending. This reduced lending will stifle economic growth, as businesses and individuals will find it challenging to access the credit they need for investments and daily operations. After a bank run, regulatory authorities often review and revise banking regulations to prevent further occurrences. These changes include stricter capital requirements, improved risk management practices, and increased oversight. While these challenges are necessary, they also lead to increased costs for banks and potentially reduced profitability. This is why it could be horrible. It has initiated a new cost-cutting drive following a £925 million bailout from investors over the weekend. It is setting its sights on reducing annual expenses by roughly £30 million, a move seen as a last-ditch effort to stave off a possible breakup or takeover by a rival British bank. The exact details of these cost-cutting measures have not been disclosed, raising concerns about potential job cuts among its 4,000 employees, including those at its 76 branches. In recent days, we are witnessing customers withdrawing their funds, reflecting growing anxieties about its stability. Due to these challenges, the management is in dire need of growth in current account balances following the announcement of the capital package. In terms of ownership, Metro Bank will undergo a significant shift, now falling under the control of Colombian billionaire Jaime Helinsky Bacal through his investment entity Spaldi. Bacal is also investing £102 million. In a rather curious twist, Chief Executive Officer Dan Frumkin is contributing up to £2 million to it as part of the rescue plan, surpassing his total pay package of £1.3 million in 2022. Additionally, its Chief Financial Officer, James Hopkinson, is expected to purchase shares worth up to £60,000. Over the weekend, the Bank of England explored potential buyers for Metro Bank, including NatWest, J.P. Morgan, and Santander United Kingdom. However, most of these lenders opted against a full-scale takeover due to concerns about its fragile monetary health and the expensive branch network. The rescue package is their only chance of survival, as they are in serious need of aid. This help doesn't even guarantee whether they will be saved or not. There has recently been a sharp decline in the value of its shares due to reports of its urgent need to secure additional funding. This significant stock crash has raised concerns among its customers and investors about the stability of it. The exact amount required to address its monetary challenges remains uncertain, whether it's £350 million or potentially exceeding £600 million. This situation highlights the vulnerability of financial institutions in today's interconnected global economy, where a single bank's economic troubles can lead to a substantial drop in its market value and erode investor confidence. The ongoing stock crisis emphasizes the importance of transparency and effective fiscal management within the banking sector to maintain public trust and safeguard against sudden and severe market fluctuations. This financial turmoil surrounding Metro Bank has had a significant impact on its customers, causing them to be deeply concerned about the safety of their finances and the overall stability of it. With Metro Bank's shares plunging due to reports of its need for substantial fundraising, its 2.7 million customers in the United Kingdom are left feeling uncertain and anxious about the future of their accounts. Customers are the lifeblood of any bank, and their trust in the institution is paramount. The sudden drop in Metro Bank's stock value has raised doubts among its customer base, making them question whether their money is secure. People who have entrusted their savings, mortgages, and transactions to the institution are now faced with the unsettling reality of a bank in financial distress. Furthermore, the lack of transparency regarding the precise amount of funds required for its recovery has added to buyers' unease. This uncertainty exacerbates the anxiety of the clients, as they are left in the dark about the true extent of its monetary troubles. For many customers, Metro may have been their chosen banking partner for years, if not decades. The news of its stock plummeting and the need for a significant capital injection undoubtedly leaves them with many questions and concerns. They are now left hoping for clarity and stability in the midst of this banking crisis, as their financial well-being hangs in the balance. The impact on customers is not just monetary, but also psychological, as they grapple with the uncertainty surrounding where they have placed their trust and their money. All these factors are converging to form a perfect formula, and the bank is collapsing due to it. The investors and other customers are concerned about the issue. The institution says they are stable, but the facts and reports show otherwise. This bank failure is the first of many, as we are set to go through very turbulent times in the coming days.